Welcome to TradeTheMBI.com. This is John. This report is for the 5th of April, and, well, no surprise, the market continues to rise. I know it seems odd. You've got inverted yield curves for treasuries, meaning the short term is much higher than the longer term, and all sorts of warning signs that the economy is falling apart or beginning to at least come to a quick stop, which is a whole different issue, but those are all perfect reasons for the market to trade counter to the outside excessive short side trade, which has already been pretty much decimated. And once it's completed, then we might see some weakness, but until then, no. Not to mention, look at the date, the last couple of days, new fund money coming in for all of the pensions and 401k setups, so it just fuels that buying. And there's been no real change in the ability for funds in that to leverage it alongside with almost no cost. So where else are you going to go? You've got nowhere else to put your money at this particular stage of the game. Now that may change, and when it does, we'll be aware of it, but has not yet. And so the paint bar, completely correct in calling this, and we can see it very distinctly from our MBI readings. Magenta is over yellow, it's above the 33 level. White is nowhere near the DSC red as far as crossover, and remaining below 5, so not even above 7 or 8, which might even cause a little bit more concern. So that's why the market's doing what it's doing. Pretty straightforward setups within that simple configuration. The euro continuing to be trounced. No shock there. It's actually way higher than it should be. But at a certain point, it's going to become more and more difficult to sustain some of these irrational things. You've got Russia moving to peg the ruble to the U.S., well, to gold, number one, but then secondarily to U.S. oil price. And this is a real consternation because that becomes a quasi-gold-backed currency from a country. And that's an interesting one because then if they start demanding payment in gold instead of alternative currencies converted to rubles, it's going to be a mess. And some people just hadn't thought about some of these equations, I guess, going forward, or they did and they don't mind. I think that second scenario is a bit more frightening than the first. From a gold standpoint, pretty flat to even. And this is an interesting one because, again, you're going to get this bifurcation because you're going to have central banks of China, Russia, Saudi Arabia, some of these others just buying up gold outside of the paper market, which is mostly what the European West market is. And there's going to be this dislocation between physical gold and commodity paper gold. So that'll be fun. Now, at a certain point, though, the physical may make the monetary paper one obsolete, particularly if it's being required to have physical gold to actually make transactions to some of these other countries. And when you're talking about oil, natural gas, I mean, we're talking significant sums here, so this is no picnic. Again, oil still maintaining over 100 a barrel, and like I've said, as the longer that goes, the more persistent and more difficult the situation is. From an inflationary standpoint, it doesn't look like anyone's making any attempt to adjust that at all, other than wear more sweaters and take the bus, which really isn't all that practical. From a TLT, still elevated, and that's just because there's going to be a significant rotation from a safety standpoint for some people, even though that yield is incredibly horrible for a 20-year treasury, given what inflation's doing. So it's like you're just voluntarily throwing money away. But in a partial hedge with the market, you have a chance to mitigate that to some degree. And from a Bitcoin standpoint, it took a nice little corrective move, filling in the positive extreme from here. This one had already been taking place, so while everyone's talking about this carnage in crypto, no, it's just pretty standardized, filling positive extreme and then returning right back to where it was. So anything special to report from that situation. ETH, same situation, filling in this whole stream of positives from the previous day, which went all the way back to the gap up. Boom. And just filled it all in nicely. That's exactly what we would expect it to do. And then returned right back to where it was. No mess, no fuss. 50K still in line, doing exactly off of the buy GAM setups that occurred. Nothing to even think about from that standpoint. And 5K was really kind of boring too, because it just was straight up. So there really wasn't a whole lot. We had a little bit of early action, it's a weak fade, but wrong color. It needs to be green. We'll just do that. Boom. And that matches the green. And so look at that separation. It's pretty clean. It's kind of what we're seeing on the daily too. Getting a little bit more of back and forth action here, post-market, right before the open, well, a few hours before. So that's the long and the short of it. I think that until things begin to start clarifying and the numbers really start to project forward about the severity and degree of slowdown within the U.S. economy, and if it's happening, of course, it's speculation on my part, but the warning signs are clear, and the evidence of what we've seen in the past really dictates how that plays forward, and becomes rather certain that these factors all lead to the same thing, which is a recession of some form, and whether that's going to be due to lack of supply or just a contraction from businesses not being able to perform one way or another, it leads to layoffs and things like that, which then has a forward accelerating effect. And like I've always said, the risk on that is always underestimated because you don't know how fast it accelerates and you don't know when it's going to stop. And that becomes much more problematic. The same things happen in all corrective cycles. Now, the Fed obviously can step in and flip around, but you're in a phase where they're no longer quantitative easing, they're quantitative tightening. Well, theoretically, they're not actually doing it, but would that force a reversal? If so, the market could go significantly higher, even despite economic difficulties, because more money flowing just got to go somewhere to make up for the devaluation. As always, though, we'll keep updating these details, but in the interim, we'll just follow what our readings give us. Trade well. We'll talk again later.